Thank you for joining us today, and also for your part in our recent CNBC ranking of #1 in Virginia, #9 nationally. It's quite the recognition. The top three criterion that they list are compliance record, number of credentialed professionals, and firm longevity. Those are all aspects that we're proud of. I'd also like to invite you to read my short ebook. Jack Burney for years told me I should write it. But I held out hoping he would agree to co-author it with me, which now I had written it in his lifetime. But I hope you enjoy it. It's a message that's timely for the type of market that we're in today, as volatility creates opportunities. And that's what Andy and Ben will address ahead. Andy?
Well, actually, I'm going to kick it over to Ben. Ben's
right,
joining
Ben,
us for the first time on this webinar. Ben, let me first intro Ben real quick. He's a member of our financial planning team. He's a wealth advisor on the team. He is well credentialed in the areas that come on financial planning. So he's going to lead the first half of this webinar before I talk more about our specific investment strategies. So Ben, kick us off.
Perfect. Thank you, Andy. And kind of looking at this chart, we kind of dive into it. There's no real way to sugarcoat it. There's a lot of red across the screen, as you'll see, with real estate and bonds really taking the hit from the Fed's retaliation of inflation, and then the U.S. markets and emerging markets, international as a whole, taking it mostly from that general inflation as well. So a good part to focus on is especially in the bond section is that's coming. The bond prices are dropping from the Fed attack on inflation. So as rates rise, yields are also going to rise. So while we may see some of the principal in those bonds come down, any new purchases or anything kind of forward looking, which is how we like to be, yields are creeping over that 4% mark. So that's one place we want to kind of focus. And then kind of the U.S. stock market is kind of leading the charge on a relative basis, and that's despite the volatility that we saw a lot of in Q3. You can see that it's still held together over there. So going to the next slide here, we're just going to focus more on the longer term view of these general asset classes. So obviously in the 1 year, it's going to be a lot of the same story. It's more of a continuation of what we saw just on a bigger basis. It's kind of just averaging down. U.S. stock market still holding strong. And this is a good reminder as to why we focus on the long term, because outside of what's happening today or this month and tomorrow, we have years ahead that we want to look forward to. So as we kind of look at the market on a longer basis, 5 years, we can start to see some of these asset classes start to turn back around. And you see the positive is there again on the long-term basis in the 5 year. And then by the time we get to the 10-year market and we get through those market cycles that we're seeing, that's why, again, we focus on the long term, because that's where we want all of our clients to kind of see that basis is, we're not worried about what's happening today or tomorrow. But we do understand and that in the short term, we don't want to get whipsawed around through the various markets. And that's why we put a big emphasis on more of a broader diversification. And in particular, one area where our clients have benefited from is, while we've seen a lot of the asset classes, actually stocks and bonds, be correlated, not only just the last quarter, but year to date, there are other asset classes in there that we've kind of been able to take advantage of. So I'm going to focus mostly on where our clients have seen that relative performance delta. Those clients that have asset allocation or are part of our planning process. You can see the managed futures here on a year to date. These are all asset class returns annually going back to the last 10 years. So managed futures is definitely leading the charge this year. This is part of our alternative asset class. And it's really a non-correlated, it's not correlated to stocks or bonds or any of those general asset classes or the general markets. And it's really able to, in terms of high volatility, it's able to be a little bit more quicker to make the turn. And so that's where in the short term, we're limiting volatility as much as we can, so that way the other asset classes can continue on, on their long-term approach, their long-term road, as we set them out to do in the first place. So that's just one big reminder there that diversification is key, and finding specific asset classes inside of that diversification to handle the various types of markets. So before I kick it off to Andy, who's going to talk more about the investment strategies moving forward, I kind of want to end on a little bit of a positive note on what inflation has brought to us. Last year, I'm sure many of you saw that Social Security benefits are going to be increased, and these are cost of living adjustments that are based off of inflation. They're going to be increased 8.7% starting next year. So it's actually one of the biggest we've seen since the early 80s, and kind of going back into the 70s. The last 10 years, 20 years has really just been a flat, steady growth, 2% here, 2% there. But really we're starting to see some bigger numbers. So for our retirees or those who are about to take Social Security, these are, the small wins we can look forward to that inflation is bringing. Another place where they were going to see some inflation adjustments are in your marginal tax rates. You can see, so on the left side, I have last year's rates or this year's rates, and then the presumed next ones for next year, and then the delta is in between here. So you can see that in the lower income brackets, it's not really shaking the needle a whole lot. But if you're someone who's just on the edge of a bracket, you can see you get a little bit more room to breathe, especially those who are in the higher earning level. You're getting more of almost a $45,000 bump before you get really thrown into that 37% tax bracket. So the tax brackets themselves have not changed. 37% as of right now is still going to be the highest bracket. But just, again, inflation adjusted things. And there are a couple other ones that we'll make note of. And mostly the standard deduction, that's going to affect most people. That's going to go up $1,800 for couples, $900 for single filers. A major one that until we see the sunset rules come in 2025, the estate exclusion is going up by almost $2 million for married couples. So now we're able to get reprieve from estate tax if anyone doesn't have a plan together for their estate. They can hide away up to almost $26 million now before they have to hit that estate tax level. And then on a more level basis, the annual gift exclusions just jumped up about $1,000 to $17,000. So this is when, if you wanted to give money to your grandchildren, a friend, anybody really, you can give away up to $17,000 without having to file a gift tax return. So those are just, again, some of the small things that inflation has brought to us on the positive side. So it's not all going to be focused just on the market, but that's one piece we really want to highlight or on the big side of what a big inflation year brings. So from here, I'll hand it off to Andy, who'll focus more on the long-term planning or long-term investment side.
Yeah, we've been in such a time frame of low inflation that I feel like these haven't been headlines in the past. So it is really interesting to see how inflation reaches out and touches all sorts of these other things. This is probably something that it wasn't thought about when we were worrying about inflation all year, but I guess there is a silver lining to everything, isn't there? So as Ben mentioned, I am going to go on and talk about, a little bit more specifically about the U.S. equity strategies that we're doing. But before I really jump into that update, I wanted to give a quick refresher really as to what our core investment strategy aims to do. And so as part of that, there's really two key parts. There's the core strategy, which is the size and style responsive part. That's the part where we're going to tilt our portfolios towards small caps or large caps, value stocks or growth stocks. And then there's also another part that is the stock selection part. That is something that we spend quite a lot of time covering. That's actually the secondary piece in importance. The main part is the size and style part. So today I'm going to focus on that main part, but I don't want to completely ignore stock selection. And in fact, the last webinar we did last quarter, we talked in depth about our stock selection models and specifically how we handle market environments such as this. So you may recall that we've used the term recovery score to talk about the way we think about picking stocks when markets sell off. And that is still the case now. And in fact, in sort of a perverse way, we get excited when we get these big sell-offs because it gives us this opportunity to turn on recovery score, which, quite frankly, has been our best performing model that we've ever built. It only works during, the immediate aftermath of big sell-offs, doesn't really work during normal time. So when we do have the chance to implement it in portfolios, we do. So if you want to learn more about that, the nuances, how we're actually incorporating that into portfolios now, go back to last quarter's webinar. That's posted to the resources section of BernieWealth.com. It'll just be the last quarterly economic update that we did. But, if you're interested in learning more about that, please watch that episode of our webinar series. But, I did want to take a little bit of time here to talk more about, the core part of the strategy, because like I said before, it really is the more important part of the strategy. And I'll explain why in a second. But essentially, when you look at the academic research out there in finance, it suggests that there's the existence of something called the value premium. And said another way, what that means is that stocks that are priced more cheaply on valuation metrics like price to earnings or price to book tend to outperform more expensive companies that you might think of as the growth companies. So over the long run, value companies have shown the performance edge over growth companies. And there's also the existence of something called the size premium, which is small cap companies outperform large cap companies. So, basically smaller companies historically have outperformed larger companies. And, there might be some explanations for that. For one, smaller companies tend to be a little bit riskier. So perhaps there is an additional premium that's demanded by investors. But it's also the case that as companies grow to a certain size, it can be difficult to maintain historic growth rates. And, large companies tend to start to decline at a certain point, which kind of leads to small caps outperforming. But, either way, if you're an academic, you're probably investing your money in small cap stocks and in value stocks, because that's where the performance edge has been. But the problem with that type of an investment strategy is it's not always the case that small and value outperform. And in fact, if you get caught wrong-footed with your size and style positioning, you're going to be in for a really tough time. I think value investors definitely felt the pain from this in the last part of the 2010s and the early part of the 2020s, when, especially the mega cap growth stocks just outperformed everything. Value really struggled on a relative basis, but it's something that growth investors are really feeling today. So I think, there's all the talk about those innovation funds and all the pandemic darlings like the Zooms of the world doing so well during 2020 and its immediate aftermath. But a lot of those investments are really struggling. So if you were, a hardcore value investor in the late 2010s, it was a difficult time for you. If you were a hardcore growth investor right now, I know it's a difficult time for you. And so what's really important about what our strategy is, we take the view that you don't have to pick one or the other. There are times when it makes sense to lean into growth, and there are times when it makes sense to lean into value. Same thing with small versus large. And so, the core tenet of our strategy here is that it has the flexibility to shift into the size and style market phase expected to outperform moving forward. And, there's a couple ways to look at that and to make that call. You may ask the question, okay, well, how do you know what's going to outperform? And there's a couple of metrics we look at. For one, we like to take a picture of the overall valuation, conditions in the market. So you can actually group value companies and growth companies separately. Same thing with small versus large, and measure how, what their valuations are as a group. So what's the price as a group relative to history and relative to each other? And you can get a pretty good picture of where things stand. Like, for example, in the dot-com bubble burst, or in that dot-com era, growth companies were priced at a huge premium relative to value companies. And so while growth was doing really well during that time, it created opportunity eventually for value companies to really burst forward in the 2000s. And, and so that valuation piece is really key to understand. But the truth of the matter is that valuations alone are a terrible predictor of performance. And that's where momentum has to come into play as well. So the next couple of slides, I'm going to show, some examples of how that comes into play. But basically, if you compare how value versus growth or large versus small do against each other, and then roll those performance differentials over a long enough time frame, you can smooth out the returns. And it's remarkable how patterned these size and style phases are. And they actually last for quite some time. So there is time to tilt portfolios one way or the other. And that's really what the strategy is aiming to do. So we'll show kind of what that landscape looks like and how we're currently positioned. But, we talk a lot about the size and style strategy, and that's what I want to do a quick refresher on right now. And, for most clients on this call, that's probably the strategy you're in. It's probably the most popular strategy at this point in time for us. But The longest running strategy that we run is something called the master portfolio. So I don't want to pretend like that doesn't exist either. So actually that's the strategy that was started by our company founder, Jack Burney, when he started the firm back in 1974. And we still run it today. We still have clients invested that way. And really it's very similar. So when we talk about the size and style stuff, much of what I say there also applies to the master strategy. The key difference is the master tends to have more of an emphasis on value. So probably won't tilt as much in the direction of growth as SSR will. It's gonna focus more on value, but a lot of what I'm saying here also applies to the master. So moving on to where we are. So I mentioned that if you roll the performance differentials between growth stocks and value stocks, you can see how patterned it is. And that's the case here. So that whenever you see blue on this chart, that's showing you that value outperformed growth over that rolling 12-month time frame. Whenever you see gold on the chart, growth is the market phase that was in favor there. And as you can see, where we are now, we're pretty squarely in a value phase. So if we look at this number here, it's at about 15% over the last year. Value has outperformed growth. And in fact, every single month of 2022, with the one exception of July, we've seen value outperform growth. And now we would typically expect a value phase like this to last somewhere between 18 and 30 months. If you look back historically and find the average length of a phase, that's about what it should be. But I actually think there might be some reason to believe that this value phase could be even longer. And the reason I believe that is when you look at the valuation gap between value companies and growth companies, it remains quite expensive. So this was through August, so it's probably come down a little bit. Values, had a better time of it of late. So it's probably not quite this big of a differential. But if you notice, the last time that there was such a huge valuation spread, said another way, value companies just looking really cheap compared to growth companies out there. The last time we saw that big of a spread was really during the dot-com bubble burst. And I'm not going to sit here and tell you that we're currently going through a dot-com type scenario, because many of one of the differences is the growth companies today are actually making money and have earnings and real businesses, which wasn't necessarily the case back then. But still, value companies do look quite cheap. And the last time, that happened, so when the bubble did burst, there was a really long time frame where value outperformed. Like if we look in this chart here, let's see if I can get the laser pointer out. We go from the early 2000s all the way up to like 2007. That's almost like a 7-year time frame where, with one slight exception, we saw value outperform. So I'm not saying that we're necessarily going to see a repeat of this, but there is precedent that when things get this out of whack, there has to be a pretty substantial reversal back to the mean to get value and growth back to kind of that long-term equilibrium of where they're priced relative to each other. So this is a long way of saying that we are, in a value tilt right now with our positioning, and it's something that we have a fair amount of conviction in at this time. One other way to kind of look at this data, and you saw this earlier with the, we call these a quilt chart, with the chart that Ben shared with the different asset classes. We can also look at it from a size and style perspective. And, one of the upshots here that when we look at the 2010s, we saw large growth outperform in like so many of these years. It was either the top or the second highest performer, year after year after year. And that type of thing can happen, but it's also not entirely normal. And in fact, is part of the reason why you're seeing growth companies priced relatively expensive compared to value. And again, so far this year, it's been a complete reversal of that trend. So value, whether it's large caps, mid caps, or small caps, are outperforming their growth counterparts pretty substantially year to date. So we focus a lot on style, so value versus growth so far in this presentation, but it is called the size and style responsive US equity strategy. So I also wanted to talk about size, and size has been a bit of an enigma during the 2010s because that, pretty consistent cycling dynamic. In this case, the blue is pro small cap, the gold is pro large cap, rolled over a 3-year time frame. But you saw some pretty substantial differentials in pretty long phases. The weird thing about the 2010s is you really didn't see small or large get a whole lot of momentum relative to the other side. And so there was a long time where like sometimes large caps would be in favor, sometimes small caps would be in favor. It would never last very long. The magnitude would never be that great. So for much of the 2010s, we actually remained pretty size neutral relative to the weightings of the entire stock market. But you can see that dynamic changed a little bit during the 2020, like in the aftermath of COVID. And we saw like large cap companies really have a performance edge over small caps. Maybe not quite as much as what we saw looking back historically, but still a pretty substantial edge. And one of the key things we're seeing now, though, is that pro large cap momentum is largely dissipating. Lowell mentioned he read in the Wall Street Journal, I think earlier today or earlier this week that they're calling for a pro small cap phase. If you look at the direction of the line of the current, large cap phase that we're in, it's moving pretty quickly over towards small caps. And what you can see is the pattern here is as the phase approaches zero, it tends to shift and continue overshooting. So that like a large cap phase turns into a small cap phase. We kind of see it over and over and over again throughout the years and throughout this data here. And it seems to be that's kind of what we're seeing again, right now. This is through the end of September. Large caps had only outperformed small caps by about 3 percentage points over the last 3 years. So it's not much of a differential at all. The question I'm posing here, are we entering a small cap phase? It's certainly possible. It's certainly something to watch. We actually are tilted right now a little bit towards small caps, but it might be something that we take another step on in the future if this trend persists. And so Ben's charts depressed me a little bit earlier in this presentation with all those red numbers there. So I wanted to leave us with an optimistic take on the stock market. I think it's so easy to kind of get caught when we're entering the fourth quarter of this extended drawdown. The inflation prints keep coming in hot. Fed's talking about raising rates aggressively. It's kind of easy to get sucked into this, pessimistic mindset. But there was a really interesting commentary that Jeremy Siegel, who's one of the foremost finance gurus out there. He's the Wharton School of Business professor, a finance professor over at UPenn. And he is, if you've watched CNBC or anything like that, you've probably seen him talking on TV. But he had a really interesting commentary that he published where he was talking, it really was truly an optimistic take. And he was talking about how the measure of inflation, a huge component of that is housing and rent. And the way that that's measured is sort of like this lagged indicator, that it's lagged so that it, smooths out the month-to-month deviations in housing prices. But at the same time, it's not necessarily, reflecting reality. And so his point was that last year, the Fed was reacting too slowly to inflation because their measure wasn't picking up on what the true rate of inflation was. But moving forward this year, you're seeing housing prices and rents really decline and not being as much of a, really not adding to inflation at all. But that's not coming through in the official Fed numbers. So his take right now is that the Fed is overreacting to the inflation picture out there. And one of the things that he points out to, and we saw some really strong earnings reports today out of some big names such as Netflix, is that corporate earnings have been very strong and have remained strong throughout this time frame. And so in his opinion, large relief rallies are possible. If we start seeing more data come in that suggests to the Fed that the inflation picture isn't quite as bad as it should be. And I've been saying this in some of my calls with clients, but right now it seems like anything else that isn't inflation is basically a distraction. So it's an inflation and how the Fed's going to react to it. And the truth of the matter is markets can handle high inflation. It can be priced in with asset pricing models. Many companies, especially if they're not in super inelastic markets, can actually pass on some of the rising costs to consumers, and so can maintain decent earnings. And we've certainly been seeing that so far. But if we're going to see inflation surprise on the downside, that's when we could start seeing some pretty big and nice rallies. And so in Professor Siegel's opinion, the market is currently 20% undervalued. So one point I want to make is it's so hard sometimes, we talk about buying low, being greedy when others are fearful. It's hard to actually do that in practice. So if you do have cash on the sidelines, and you may have thought that, after July, we had a pretty big rally through July and the mid part of August. If you thought you missed the boat on buying low, you've got another opportunity right now. So you might take Jeremy Siegel's comments here as a sign to go ahead and get any cash you have on the sidelines invested in the market. Buying at a 20% discount is typically a pretty good move when it comes to investing. Sometimes it's easier said than done. But I know that that's something that we've seen a lot of people do here recently. So as part of the registration to this webinar, we did ask for questions, and boy, did you guys deliver. We have a lot of questions. I'm not sure we'll even be able to get to all of them. If you guys don't mind, we might actually go a few minutes over. Normally these things only last 30 minutes. I know we've got 5 minutes until 1 o'clock here, but I do want to take the time to answer some of these questions, because a lot of them are sort of like, the hard-hitting questions of the day. So I've kind of grouped these, and they're kind of maybe 4 or 5 main themes. Maybe the first theme here we'll talk about is just the general economy. So I know there's been a lot of debate out there about, are we in a recession? There were quarters with negative growth consecutively. We're seeing some economic growth, maybe on the negative side of things, but at the same time, the unemployment picture remains, robust. People aren't getting laid off. We're sub 4% when it comes to unemployment. And so it's kind of weird to talk about recessions when unemployment rate is so low. So the question here is do you feel we're in a recession? And if we do end up actually falling into a recession, what would be the implications of that? So Lowell, let me kick you off, and maybe you can address some of these recession concerns that people are expressing.
Sure. And I just want to also share, Andy, if you look in the Q&A for today, there's a question in there also that I don't know if we're going to have time to get to, but at least look at it. Ben, the other one is just asking for the deck. So we'll post that, I'm sure, someplace where everybody can have access to it. The question that was asked by one of our clients actually specifically addressed stagflation also as a concern. So let me start with that, and then we'll work through the recession. So the definition of stagflation is higher rising inflation, definitely have that, low economic growth or declining growth, or even a recession. We're seeing some of that. But it also requires high and rising unemployment. So that's the condition that doesn't exist yet for this to be stagflation. And then there was a concern that we might be on a path similar to Japan. Of course, they're pretty well known for their long period of not stagflation. In their case, it was economic stagnation. So their problem was just no growth. And the main driver of economic growth is workforce increases and productivity increases. And in Japan's case, they haven't had that workforce increase, and they're not planning to. Just the whole way that society sort of drives, they cannot have a lot of economic growth because they just don't have the one half of that equation. Doesn't mean they don't still enjoy high standard of livings, but I don't think Japan is the appropriate benchmark for us, because we do have kind of both barrels going. We still have workforce growth in our economy, and we still have productivity growth that gives us a much better prospect for achieving economic growth ahead. So moving to recession now. So recession requires both the economic decline that we've, quarter to quarter, that we've already kind of met that condition. I think all of us assumed that was the only definition of a recession, but the official arbiters of recession also have an employment component to it, an unemployment component to it. And again, we haven't seen that yet. So we're not technically in a recession yet. To me, that's a technicality. What we are in is a period of slowing growth as a response to the Fed's policy actions. There's enormous uncertainty in their decision making, and there's absolutely a chance that they could sort of over-constrict and actually tilt us into a real recession. So that would be not just the economic growth decline, but also the accompanying unemployment that would meet the definition of a recession. There's just no way to know, but low growth by itself is not a great condition if you're a stock market investor. The one thing that I have a fair amount of confidence, and this is going back to Paul Volcker and the inflation of the 70s, is the Fed knows they have to break the back of inflation, and they're going to do that. And they may not do that elegantly, but they're going to do that. And so this inflation concern that we have today, I don't think is going to be a concern, at least not to the same degree, a year, 2 years, 3 years, 4 years from now. They're going to be able to move the levers to affect that. And then I think it's just all about, as Andy talked about, what are the companies, how are the companies actually performing that we're investing in? And if they have that ability to pass through, their rising costs, that's actually not a good condition, because that propagates inflation by doing that. But as long as they're able to do that and continue to create, strong earnings, I think the stock market's going to, our investments are going to be fine. And keep in mind also that the stock market declines as it relates to recession. The pattern historically is markets decline ahead of recessions. And, the saying that they've correctly predicted 20 of the last 6 recessions is kind of the way that not every decline leads to a recession, but you're pretty much always going to have a major decline if there's going to be a recession. But stocks actually rise during recession. So stocks, a recession is not something for us to fear. That's a really poorly understood sort of dynamic in the timing of when stocks perform. So there was another question, and I'll just get to this, Andy, and I'll pass the baton, but relates to what are our expectations for the market ahead. So my first boss, Ted Rosenberg, his pat answer was always, the market's going to be volatile for a while, and then it's going to rise. And it's what it always does over time. I think all of that's true. The one thing that I'll add to that is, and Andy touched on this before with our recovery score model and how we look at this, there are outsized opportunities when the market gets disrupted like this. So this is actually from a relative return basis and ultimately on an absolute return basis over time. These are not bad conditions for us as active investors.
Yeah, that's a thorough answer there, Lowell, and I think it definitely touched on a few of the questions that we saw here. So I'm going to move on then from some of these economic questions, and if we didn't answer your question, please reach out to your advisor. We're happy to go there. There was one that's kind of timely. We all know that the midterm elections are coming up in November, and we did have a question that was talking about what effect the election will have on markets. And so I wanted to take this opportunity to maybe reshare one of the slides that we actually did back in 2020 when the presidential election was happening. But it shows the historical relationship between elections and stock market returns. And so you don't see many bars on this chart here, and that's kind of by design. So the strength of the relationship, that's really the correlation. So we can see when we have a Democratic president, which is the case we have right now, and Democratic Congress, which is the first bar there, divided Congress, which seems like it's a potential likely outcome of the election, or maybe even a Republican Congress. Really, it's sort of like an uncertain election year, because we could have any 3 of these scenarios play out. But the fact of the matter is, there's almost no correlation between who holds office, both the presidency and Congress, and stock market returns. And the reason is there's just too many variables at play that impact stock market returns. So certainly economic policy is something that can play some role in there. I'm not going to say that there's absolutely no link between that and possible stock market returns, but there's just so much else going on between, economic growth, which tends to be completely outside of anyone's control who's in power, just geopolitical situations, the general valuation levels of the market. So just when we look back historically, sometimes it's easy to try to cherry pick certain trends, but when we look back, there's almost no relationship. So our best advice when it comes to elections, vote for your preferred candidate in your elections, but keep your portfolio separate from your politics. So getting back to some other questions here, there were, you kind of talked about the market outlook, Lowell, so I'll skip right past that question for now. But there were a few questions where they're all different, but the common theme was really on volatility and how we handle it with our portfolios. So I'm just gonna mention that some of like our core beliefs here that aren't going to change are, you'll never see us go to cash, tactically to try to avoid stock market pain out there. We just don't believe that you can reliably do that. And keep in mind, if you do try to go to cash, you have to be right twice. You have to be right getting out of the market and then when you get back in the market. So we're going to stay invested, and in fact, it's our opinion that the price that you pay for the excess returns available from stocks is the market volatility. So it's these periods of pain. That's the price you're paying over the long run to maximize the growth of your portfolio by investing in stocks. But so that's kind of like our core belief there. I will say there was a question here about hedging. We've looked into hedging before. We've looked into various option strategies. And at the end of the day, when you hedge, you're either hedging in a bull market, and so you're just sacrificing return when you pay the premium to hedge, or you're trying to put options on to hedge during a volatile time frame, and all of a sudden that same hedge is much more expensive. So it's been our experience when we see people try to hedge, it's just not worth the cost. So perhaps a better way to think about this, and this was actually a webinar I did last month again. So I'll promote berniewealth.com resources section there if you want to see the most recent webinar that was done that really talks about how to think about volatility. So, oftentimes we come to an asset allocation. So for many of you on the call, that might be 100% equities. For some of you, it might be, some other type of asset allocation mix that was determined when you started to become a client of ours. But sometimes, the choices that you make in terms of how much risk you think you can take in a normal market environment, when you're calm, you're not stressed, you're sober, so to speak, is not really what you can handle in a live period. So, now, we're in a period where the markets are down. It's much more stressful. If you're looking at your portfolio, you're probably seeing it decline in value some. And sometimes it's during these times that we really figure out that, hey, you know what, this asset mix really isn't right for me. Maybe just the way you're feeling, maybe you're losing sleep at night, maybe your situation's changed and, you're thinking about retirement or other sort of long-term financial goals. So I think oftentimes, write down how you're feeling now, remember that feeling. I wouldn't suggest making any major changes right now, right this instant. But I would suggest, remember how you feel now. And when markets do inevitably decline, like Lowell, you mentioned Ted Rosenberg saying that there's going to be volatility and then markets will recover. When we get to that recovery phase, it's time to reevaluate maybe how you're positioned. So, Ben, I know this is something that you do all the time, every day, working with clients. So can you maybe walk through how Bernie Wealth Management thinks about the whole asset allocation decision?
Yeah, and it's not like I can't give you a one word answer, obviously, which is what we're asked for sometimes, but it really comes down to, we have a process in our planning process, and that's part of how we determine asset allocation. And it's taking you through, we want to learn about you as a person, not just an investor, but what is your relationship with money? What is your relationship with investments as a whole? Were your parents around in the Great Depression? That has a lot to do with how you think about investing. And then we take that information, we park it on the side, and then we get into building a bigger plan that really is looking at your age now until your age 100 and all your goals you have in between. And, what does that look like? And if you make it comfortably on what you have, and we're using modest growth rates, then you obviously don't need to take on a whole lot of growth. So it's kind of twofold, and we'll also do some risk tolerance questioning. But we really just want to make sure that you understand that from a planning basis, the goals that are going to happen. Those are the things you need to focus on. And we want to make sure those can be accomplished no matter where the market is on a day-to-day basis. So if we do all that and we determine, hey, you are a pretty aggressive investor, you can take on the risk without, affecting your long-term plans. Then there's options for you to be still diversified, but in an aggressive way, and then all the way down to a conservative kind of allocation. So it's really, I would say it's kind of trifold almost. It's not just how you think about investments or just how your planning approach looks, or just, how you've invested in the past, but it's really a combination of all that. And that's part of what our planning process really determines. And so that's one thing I'll kind of take a pause, and just like Andy's going to promote, our resources page, I'll promote, our planning process in general. And, if you have questions on building an asset allocation, I think we had a question on, hey, I want to retire in 10 years. how should I invest between now and then? And 10 years is not a time to slam the brakes and say, okay, I'm going to wait 10 years, because 10 years is when retirement starts, but you still have retirement to live in, right? So it goes beyond that 10 years. And that's part of what our planning process really helps deliver and help show is, how do we make it past there? How do we live through retirement? What does that look like? So I hope that kind of answers the questions, but it's really, asset allocation is going to be different for everybody. It's not just what your neighbor down the street's showing you that he has. And then in years like this, Andy, you've said on previous webinars that when a market falls, it can be for different things. And, that's true in this one as well, where I just mentioned earlier, we're looking at stocks and bonds. They're supposed to have an inverse relationship, and now they're pretty correlated. So where do we go and find even deeper parts of the asset allocation that can benefit you in the short term? And that's kind of all goes into that process of asset allocation.
Yeah, that's a great answer. So if we've got a current client of ours on this call who maybe is interested in learning more about that, Ben, what do you recommend they do to kick off the process?
Yeah, so they can, reach out to me directly, or if you call the office, you'll get to me. And, really we kind of go through that, and that's where we're going to start. The first meeting is really just sitting down and us learning about you, and outside of your investments that we're already managing, who you are on the street and everything like that. And we kind of build that process from there. So yeah, reach out to me directly, and we'll get you put in the process and go from there.
Great. Sounds good. Well, I think that's a good spot for us to end today. I know we're about 10 minutes over time here, so I appreciate all the questions. There might be a few questions that came through that we'll follow up on. If you're interested in getting the slides, for example, yes, we can certainly send them over to you. There will also be a recording of this webinar that we're going to post again to BernieWealth.com. So if you know anyone who might be interested in this content, feel free to forward it their way. But I just want to take the moment for Ben and Lowell to thank everyone for joining us today on the webinar. And we hope you have a great end of the year. Thanks.